When you look at the strategy set forward by Goldman Sachs, help us understand, Goldman Sachs stock has been lagging on a price-to-book basis from some of its rivals. What are investors not seeing? What is the math here on why Goldman may be worth more than the stock is currently showing?
Well, first of all, it's great to have you in our building. Thanks for taking the time. Today was an important day for us. As you said, it was our second Investor Day in our 23 or so year history as a public company and our 154-year history as a firm. We've committed to talking to our investors on a more regular basis, and so we did our first Investor Day in January of 2020, right before the pandemic, and then we had 3 years of clearly very complicated, volatile markets, and so we're now updating our investors on what we've done over the past 3 years, and spending a lot of time talking about our strategic realignment, which is an important evolution in our journey to further align our businesses to create more durable returns and long-term value over time.
Is there a Goldman 2.0 here when you take a look at the strategy, or is this kind of an incremental path to get to where you want to go?
Well, I think if there's a 2.0, it's really talking about having 2 market-leading businesses, Global Banking and Markets and Asset and Wealth Management, which are businesses we've been in for a very long period of time, now run together in an integrated fashion. Global Banking and Markets, a $30+ billion revenue business, generated 16.4% returns last year, definitively outperforming our competition. We've done a great job in those businesses, and now when you see them together, you see the power of those franchises, and you see some of the diversity effects of those franchises, where in some cases, market headwinds for certain of the franchises that are tailwinds for others, and vice versa, and you can see those businesses really performing across cycles in a mid-teens returns kind of manner.
When you think about asset and wealth, I'm really curious about how much you're willing to invest. Well, is this something you think you'd do a large transformative deal around in order to gain scale?
Well, let's just talk about the organic opportunity in asset and wealth management. And today, again, in Global Banking and Markets, Dan Dees walked through the story. It's a very, very compelling story. In Asset and Wealth Management, my partner Mark Nachman walked through that story. And to your question about a 2.0 version, we're now running Asset and Wealth Management as an integrated platform where we have scale in active asset management. We're a top 5 player in active asset management, and we're a top 5 player in global alternatives. I'm not aware of another platform that has our kind of scale in both. That's pretty unique. And then we have a premier wealth management franchise with $1 trillion of assets on that platform.
We have to also talk about kind of this years-long journey in consumer as well. You've said you're considering strategic alternatives. How much detail can you give us around what those strategic alternatives are? Could it mean the sale of all or parts of the business?
Well, before I address your consumer question, and I will address it, just in asset and wealth management, this is a very important, again, back to your 2.0 question, this is a very important growth opportunity for the firm. With the scale I talked about, we now have significant fundraising objectives in front of us. We have a significant management fee target in front of us. We now have $8.8 billion of management fees in that business against a $10 billion 2024 target. We're clearly well on our way to hitting that target, and that target is not the limit of our ambitions. $2 billion of that $10 billion target would be from alternatives. We're now at $1.8 billion on that $2 billion target. So in both cases, total and alternatives, we are well on our way to hitting and exceeding those targets, which will make the firm more durable, more resilient, and more valuable. And so that 2.0 version of asset and wealth management is going to be a significant growth vector for the firm going forward, where you have 2 market-leading businesses, both mid-teens returning businesses, both durable, both resilient through the cycle, both where we are market leaders, which really underpin the financial targets we put out today with our investors.
So that's the future, but as you get there, there's still this idea that it'll take 2 years for the consumer business or the platform solutions business to break even. Do you think investors will be patient with you along that journey?
Well, you asked about consumer. Okay, so we talked today to our investors very much about our path to profitability. We basically said we would do 3 things in the firm. 1, we would grow wallet share and grow our financing businesses further than we already have grown them, and we've grown them considerably. 2, we will grow our management fees. And 3, we will create profitability in platform solutions. We will deliver profitability in that segment. That segment has transaction banking, which is a profitable business, and it has consumer platforms, where obviously we have had losses. In those consumer platforms, we have a plan to drive to profitability. We told our investors today we would drive to profitability in 2025. We likewise said that we will look at and explore and are exploring strategic alternatives to make sure that we understand all opportunities in front of us to unlock value in platform solutions across those consumer businesses.
Another big thing that you said today is that you can cut another $1 billion in costs. Where do those costs come from, and how much of those costs come from additional headcount reductions after already making 3,200?
Just to be clear, we talked about $1 billion of operating efficiencies. And then we talked about reinvesting some or all of those efficiencies back into the core franchises. That's an important differentiation. Okay, so we obviously did some work on our headcount coming into this year. Some of those benefits will flow through 2023. Some of those benefits will flow through 2024. We're working hard on some of our other expense-based items, non-compensation items in particular, whether that relates to other marketing expenses or operational expenses in the firm that we can defer and be more judicious about. So we're looking across all of those items. That totals $1 billion of efficiencies over time. But importantly, we will look to reinvest those efficiencies back into our core franchises, dependent upon the performance of the firm and upon the broader market environment.
Now, I want to pivot a little bit here because I want to talk about the culture of the firm. You know, it's interesting, for all of the talk of the turnover, you've given an interesting statistic that turnover is at a 5-year low. But at the same time, as UBS puts it among investors, that there's a concern about the loss of confidence among partners. What are you doing to bring partners back on your side?
Well, we said earlier today to our investors that we, for the first time in 4 years, were able to bring all of our partners together for an offsite. We had many versions of that during the pandemic, but we couldn't get everybody together given the obvious travel restrictions during the pandemic. So for the first time a couple weeks ago, we were able to get everybody together. And I would say it was an extremely productive and valuable meeting where our partners walked out of that meeting very optimistic about the future of the firm, very optimistic about the investments we're making in the forward of the opportunity of the firm, particularly in those two market-leading businesses. And then, like many others, have questions about how long will it take to drive platform solutions to profitability. So certainly those questions come up. Some of those questions spill out into the press. But I think if you looked at our partnership and you walked around and interviewed our partners, they are firmly behind the strategy, firmly behind the opportunity, and very excited about what's in front of us at Goldman Sachs.
I have to go back to a prior question because I feel like I still need an answer. Do you think that when it comes to the asset management business that you can do something transformative at this phase, especially given when you look around the markets that they've sold off so much?
Well, if you look at our strategy and you listen to what we said today to our investors, we have plenty to do organically. We have significant opportunities in front of us to drive wallet share and grow financing in our banking and markets businesses. That's an organic strategy. In asset and wealth management, we have significant opportunities to drive management fees. We have significant opportunities to continue to invest in our platform operationally and to grow our wealth management business. All of those opportunities are organic. We can always look for inorganic opportunities. We have, as you know, we've made acquisitions. We bought a business last year in Europe called NNIP, which has added substantially to our European footprint in active asset management, has given us very interesting ESG capabilities across our asset management platform. There are always things we can look to do, but our appetite right now is most interestingly driven by the organic opportunity.
John, I can't let you go without asking about the broader macro environment here. You know, just rate expectations have changed drastically in the last couple of weeks. How has it changed the calculus among your clients for risk appetite? How has it changed the calculus for you for risk appetite?
Well, I would say if you think about what was going on at the end of last year, there were significant concerns in three primary areas. One was the European energy crisis. Two was China and zero COVID. And three was the performance of the U.S. consumer. In all three areas, things have broken to the high side. We didn't see the energy crisis that everybody predicted, maybe somewhat driven by warmer weather, but it didn't occur. And so the European situation improved. Nobody predicted that the zero COVID policy would pivot very quickly to opening up China largely completely. That has changed materially. That's a much more significant upside surprise. And the U.S. consumers outperformed. So to me, all three of those elements broke to the high side. What I think today everybody's wrestling with is how permanent and how secular a change is this inflationary environment going to be. Most of our clients are very concerned about the inflation, particularly corporate clients. They see it being more persistent in their businesses. The marketplace is a little bit more complacent, I would say, on inflation in terms of how the market trades inflation. That, to me, is a disconnect that has to get adjudicated over the course of the year, and we're obviously keeping a close eye on that.